All right, good afternoon, everyone. It seems like there's a few people online already. I believe there's been quite a number of people registering for this webinar, which is great to see. Maybe just a quick check. Can you all hear me? Maybe Sailesh, if you just give me a thumbs up if you can
Yep,
hear
I'm
me.
able to hear you. Thumbs up.
Fantastic, thank you. Right, I think we're going to get started because this is quite a full session. Quite a bit to get through, and very excited, obviously, to be able to host the session today. So what I do want to ask though is that everybody just make sure that the mics are on mute while Sailesh is going to do the presentation and also do a bit of a demo of the platform on how this works in practice. And then we will have some time towards the end for Q&A. So welcome to post your questions, and then we'll run through those as well, and hopefully get through as many of those as possible in the given time. So without any further ado, I'm just going to introduce all of our attendees to our speaker today, Sailesh. So Sailesh is a researcher and a practitioner in the global equity allocation with a focus on systematic country investing and macro-driven portfolio construction. Sailesh's work has been published in practitioner journals, including the Journal of Portfolio Management and the Journal of Index Investing. He's developed frameworks for forecasting country returns and constructing global rotation strategies, and brings over 2 decades of experience spanning equity research, economics, and technology. So it's a real pleasure to have Sailesh here. Sailesh, also the founder and CEO of Borealis Global Analytics. And today we are going to hear about Sailesh's webinar called Reimagining Global Equity Allocation, a factor-based framework for country investing. So the question then that's asked based on this webinar is whether country allocation can be approached systematically with the same rigor as stock level factor investing. And those of you who are academics online, especially, will of course be very familiar with the factor-based investing. I certainly am from my academic days as well, and which I shared with Sailesh, is that why I'm quite excited to host this webinar today, because this is something that's quite close to me personally as well. And so overall, the webinar provides a conceptual and practical framework for global equity allocation, and then linking the factor-based insights with macroeconomic context in a systematic and transparent manner. So that's where I'm going to hand over to Sailesh. And Sailesh, if you want to maybe add a little bit more about yourself and the background, of course, also related specifically to this research and this paper. And I'm sure that the audience is going to be very excited to hear what you have to share.
Perfect. All right. Good evening, everyone, and thank you for having me. Thank you, JD, both the Helens and Teresa, for inviting me and my firm. Borealis Global Analytics was founded to operationalize decision intelligence for global equity allocation. We are headquartered in Blythewood, South Carolina. It's about 60 miles south of Charlotte. And Borealis is a quantitative AI-enabled research infrastructure fintech company designed to convert publicly available market factor and macroeconomic data into a decision-ready intelligence. Rather than functioning as a data terminal, we operate as a decision intelligence layer, automating economic interpretation, structured reasoning, and portfolio action at institutional scale. Today, I'd like to walk through a simple but important idea that global equity investing is undergoing a structural shift, and that this shift requires us to rethink how we allocate capital across countries. What I will try to do here is connect academic research, empirical evidence, and a practical framework into one coherent way of thinking. Right, and this presentation, the crux of the entire presentation, boils down to a sort of a workshop or a demo, which is basically an educational demonstration of how do we apply this practically, the new framework, which is the systematic um, uh, country-based, factor-based country allocation. How do we do it systematically? So if we step back and look at how investing has evolved over the last 2 to 3 decades, there has been a clear transition Historically, alpha was primarily driven by selecting individual securities, or primarily through bottom-up security selection. But with the growth of ETFs and passive investing, capital now is flowing at the level of indices and increasingly at the level of countries and regions. So, as you said, as a matter of fact, capital flows now increasingly operate at the aggregate market levels and influencing return across equity markets. So, the unit of decision making is shifting, and that changes where alpha comes from. And so, traditionally, country allocation has been discretionary, driven by macro views, narratives, or qualitative judgment, right? But literature is increasingly showing that countries exhibit persistent return differences. And importantly, these differences are not random, they are structured and measurable. Right? These differences are linked to valuation difference, dispersion, momentum effects, macro and risk characteristics. And these return differences or the factors that contribute to these return differences can be quantified. Research shows us that, and ranked systematically and integrated into portfolio construction frameworks. So importantly, as I said, these return differences are not random. They are structured and measurable. So the natural question becomes, can we systematize this process? Country indices based on research exhibit factor-like behavior, enabling systematic allocation approaches analogous to equity factor investing. The foundational breakthrough, the early literature that focused on a very basic question: do country markets or country indices actually exhibit predictable return variation? If markets were fully integrated and efficient, these differences should not persist, right? But the data shows otherwise. Valuation differences persist. These valuation differences can predict returns, and macro conditions matter as well. This was the most foundational breakthrough, meaning country equity markets form a valid cross-sectional asset pricing framework, enabling systematic allocation approaches. This is not a trivial finding. Why? Because traditional asset pricing theory assumed global markets are largely integrated, because the traditional asset pricing frameworks, the APTs, and all the CAPMs and all that, the FAMA French three-factor, they all assumed, and they were all built around firm level characteristics, US-centric data series and data sets. An assumption was full global market integration. Of course, under these assumptions, right, cross-country return differences should be arbitraged away. But empirical evidence, what we in reality we observe, is that capital is not perfectly mobile. Information does not travel instantaneously, and structural differences across countries matter. So what we are seeing empirically is that instead of full integration, what we actually have is partial segmentation. So global equity markets, according to research, are partially segmented, not fully integrated, enabling persistent cross-country return differences. So the factorization of countries. Once predictability was established, the next step was natural, right? Applying factor-based equity investing principles to countries as well. And I just want to take a little bit of a refresher here. Dodd and Graham instituted the framework, the value investing framework, in the 1930s. But the breakthrough was the modern portfolio theory, Markowitz and Sharpe, when they institutionalized CAPM in the 1960s. They said only non-diversifiable risk can investors only can expect compensation for non-diversifiable risk, called the market risk premium. But then the race started of, is it true? They're trying to validate the CAPM, and they said, we could split the market risk premium into other set of premiums. And then we saw in the 1977 the seminal paper by Basu, which said, you know what, the market risk premium also constitute value risk premium, and then the proliferation of factors, value factors happen. The price to earnings, the price to cash flow, price to sales, price to book value. There's a proliferation that happened in the 70s and the 80s. But this race to basically distill the CAPM's market risk premium didn't stop there. In the legendary Titman's and the Jagdishan paper, they found momentum. Then everything got crystallized. They distilled CAPM into a three-factor model in the 1990s, early 90s, capturing value risk premium and size risk premium. So whatever was left was the after adjustment of the size and the market and the value risk premium. That was the market risk premium that Fama French distilled, right? That became a Fama French 3. But that didn't stop there. Carhart, based on the mutual fund data, also said momentum risk premium could be added to the Fama French 3, called the Carhart four-factor model. But right about the late part of the 1990s, Fama French came back, ignored momentum completely. They believed that it's not an anomaly. It's basically a recalibration process. And they brought in two more factors called investment and profitability, which got captured under a common umbrella called the quality risk premium, a quality premium. And then in the 2000s and 10s basically gave rise to the low risk and other anomalies that came into the thing. So I just want to be very clear when we talk about factors, right? We're talking about we do use the common term called factors, but actually there are different names for it, and it's as marketing terms, the kind of term for it called smart beta. Smart beta is nothing but these factors, cross-section anomalies. They all mean the same thing, but we call them as factors. So just a refresher background of what these factors mean and what the evolution of factor investing has been in these stock markets. So at the country level, right, once the predictability was established and the next step, as we said, was applying factor investing in countries, what we see was very interesting. Value, momentum, size, reversal, the behavioral aspects of it all appear at the country level as well. So country indices exhibit factor-like behavior, enabling systematic factor-based allocation across global markets. But the most important thing here is, while the structure is analogous to the factor-based stock investing, the dynamics, the drivers of these anomalies of factors are completely different at the country level compared to the factor-based stock investing. All right. And we see at the country level, each factor reflects some sort of a macro dynamic mechanism of realignment that happens. Value reflects macro level mispricing, often driven by pessimism or crisis. Momentum reflects sort of a capital flow dynamics and slow information diffusion. Size reflects liquidity constraints and structural inefficiencies. And of course, reversal was basically sort of a long-term overreaction to macroeconomic cycles. So, as I said, it is analogous to the factor-based stock investing, but the dynamics behind these anomalies or cross-sectional anomalies are completely different when compared to the factor-based investing in equities. These, as I said, the country level dynamics are not firm level effects, they are system level effects. So country level factors mirror stock level anomalies, but they are driven by macroeconomic, structural, and capital flow dynamics. There are two kind of factors when you talk about the categories of factors that apply to factor-based country investing. There are two kind of distinction that's made in research, right? One is the transplanted factors, the ones we borrowed from factor-based stock level investing, like value and momentum. Second, which is pretty much an addition, are the sovereign or macro factors, like political risk, institutional risk, capital flows, news. A lot of other things happens at the country level, and they're pretty much an addition that you don't see at the firm level or this factor-based stock investing. This is where the framework expands beyond the traditional factor-based equity investing. So country investing or the factor-based country investing integrates market-based factors with sovereign macro drivers, expanding beyond traditional equity factor frameworks. And this is where you need to take a pause here, the insight here, right? At the country level, the unit of analysis changes completely. A country is just not a portfolio or index of firms. It is pretty much a complex system defined by policy, institutions, capital flows, and macroeconomic conditions. So the country returns that you're seeing at the country level are inherently multidimensional. So the country returns embeds both financial market information, which is the firm level information aggregated, plus the macroeconomic and structural signals. This is pretty much a nuanced interpretation of how you look at country indices, right? So it embeds both financial market information, macroeconomic and structural signals. Even though it is an aggregation of firms, there's an additional dimension, the macro, the policy, and the institutions. In terms of how they operate, in terms of speed, the temporal dynamics of all these cross-sectional factors, they're similar. They act similar to what happens in the factor-based stock level investing, right? Momentum tends to be very, very fast. Value works relatively slow in the short to medium term. Macro or the reversals, they take medium to long term kind of thing for realignment. And so timing and horizon matter. So country levels factors or signals vary in speed, requiring multi-horizon frameworks to effectively capture return dynamics. And we did talk about it briefly in one of the slides earlier. The reason why all this comes back to the same idea. Markets are not fully integrated. Even though there's a trade integration, there are other financial intermediation integration, but they're not fully integrated. If they were, arbitrage would have eliminated their differences. But in reality, frictions remain. Capital constraints, right? Some nations have capital convertibility issues, some have trade convertibility issues, they have capital controls, information gaps, and institutional barriers. And that's what sustains predictability. Partial segmentations sustains cross-country return differentials, creating opportunities for systematic allocation strategies. In country selection, and based on our research, we have realized that country level investing also comes with sort of few challenges as well. It's very, very sensitive. The results of country selection allocation is highly sensitive to how portfolios are constructed, market weighted, inverse volatility weighted, equal weighted kind of a deal. Currencies matter, and what based on our research, US dollar denominations have been very robust, and on the indices matter, whether you use MSCI, FTSE indices, or any of the other indices that's available, didn't matter. And they have their own set of challenges. I wish our research has uncovered a lot of issues with the indices as well. Many major index providers have their own set of issues. And if you've been closely following the MSCI framework, there's been issues in the Serbia index as well, and recently in the way they compute some of their indexes too. So robust country level factor investing requires careful methodology design, as results are highly sensitive to construction choices as well. So the field, as I said, we talked about briefly, this field has basically, using a factor-based country level investing, has evolved beyond traditional factors. We have seen factors that were related to credit risk, political risk, economic freedom, capital flows, and even news and sentiment become a very crucial part of factor-based country level investing. Right? So they extend beyond market-based factors to also these macroeconomic, political, and information drivers, which we discussed in a previous slide. Now, the biggest challenge in research, and I've seen, is that I've been a student of this field for a long time. There's a significant gap in this literature in terms of research. It's about all this progress, right? There's a major gap. And the gap here is most research, as you see, is backward looking, and every factor are studied in isolation. They don't combine factors in your studies. They don't do multi-factor studies. It's just single factors. They either do value, they take price to earnings signal, they might use price to signals, they might look at short-term momentum, trailing 6-month momentum, whatnot, but they do it in isolation. But for practical application, for real world decisions require integration. The problem here is not of insights. It's just we don't have a unified framework. There remains a gap between empirical factor evidence and how we can integrate forward-looking allocation frameworks into portfolio construction. So how do we design this new framework, right? So what should a typical complete framework should look like? It has 3 layers, should have 3 layers. As we discussed, the systematic factor analysis that we discussed, forward-looking macro interpretation is very, very important. And you see in all the available tools and methodologies that's out there in the world, nobody adapts that into factor investing. Even at the stock level investing, you don't see it. And that's one of the challenges that I'll discuss in a later slide. And of course, portfolio construction. So effectively, country allocation requires integrating not only the factor-based principles, you have to layer in a macroeconomic interpretation, which systematized processes are lacking at this point, and a portfolio construction, which pretty much is robust nowadays into a unified decision framework. So what does this systematic factor-based allocation framework look like? Right? So the advances we have seen here, right? This systematic framework allows us to rank countries, right? Construct portfolios and evaluate performances across multiple macroeconomic regimes, time series based, cross-sectional based, longitudinally, or cross-sectionally. So in other words, this systematic framework that we are developing should be able to enable scalable, repeatable country allocation grounded in empirical evidence, right? So how do we go from signals that you get from your research, how do you make it to a decision points? This is the most important thing which is not discussed, never done it at the country level at all. So most approaches that you see, they're basically stop at identifying signals. But how do we integrate those signals into decisions? And this is where we come into the picture, practitioners come into the picture. How do we integrate research and investing? The true value of factor investing lies not in signal identification, but in systematic integration into dynamic portfolio decisions. And this is where this domain of country selection is under-instrumented compared to stock level investing. If you look at all the tools, it all caters to stock level. Most of the macro-based country selection is basically discretionary, judgment-based, and fragmented. There is no systematic element that's available. And this is where the factor-based investing, both at the stock level, fail. And this is the kind of framework that we as researchers, I as a researcher, have basically added that layer. So what is missing, as I said, is the macro integration. So I've told JD in a conversation, since this is just basically a 40-minute discussion, I'm going to skip this macro integration in elaborating because this needs a session of its own. And what has made this field so interesting is that LLMs have made systematic application of macro decisions integration on top of factor investing very, very interesting as an LLM solution that I've devised in terms of research. And so I'm not able to do this in elaborately, but I'm just going to go through a brief few lines on why macro integration is needed. All right. Factor models alone are very hard to interpret. Why? They are historical analysis. They look back in time. Or what does macro analysis help here? It tells you, why do these factors exist? At what point will they change? Will they persist? Now, how long? It's very, very important. Why macro analysis is very important. And that is not done even at the factor-based stock investing as well. So that's really lacking. And that's why I feel this factor-based country investing is very under-instrumented. The macro layer is just lacking. And LLM has given us a great solution how to solve some of the challenges there. It gives you the macro analysis, or the macro integration gives you a layer of economic meaning. It takes integrating macro intelligence, transforms factor models, right? Value, momentum, whatnot, from descriptive tools into forward-looking, interpretable allocation frameworks. So we talked about systematically applying factors. Now we're talking about a macro integration. And that combined framework is necessary. And right now, even the factor-based stock investing lacks macro integration. And we are adding that layer as well for country investing as well, right? So the combined framework, when you combine the two, the factor-based principles with the macro integration, factors give you statistical signals, right? Macro, what does it give you? The causal interpretation. Why does it exist? When will it change? Will it persist? For how long? Together, they create a more robust system. Combining factor signals with macro interpretation enables a more complete or coherent framework for country allocation, right? And so why does this matter? Why does country allocation matter? And historically, global equity allocation has been primarily been driven by bottom-up security selection. And we've been leaving to on the table sector-based alpha. We're talking about um, country-based alpha. We're leaving them on the table, right? And the advantage here is that country level, you're dealing with fewer assets. We're talking about 48 countries emerging and developed, plus about 30 frontier countries. We're looking at 70 to 80 countries. Fewer assets, clearer or cleaner signals. The noise to signal ratio is very, very low at the country level compared to the stock level. And it also offers you better scalability, which makes it particularly relevant for institutional portfolios. So country level allocation provides a cleaner, more scalable framework for capturing systematic return drivers. What are the institutional implications for this, right? This implies a shift of how portfolios are constructed, right? Initially, we did from discretionary to systematic, from stock level principles to country level principles, and from static to adaptive because of the integration of macro layer, right? And as I mentioned earlier in a slide, we have worked on a detailed LM platform for this, and I've done a lot of research. The white papers I have, and a couple of research papers which I've left it with JD to share with you after this conversation, because this conversation is just primarily on factor based. I don't have enough time to cover the macro as such. So institutional success increasingly depends upon systematic adaptive allocation across countries that includes the macro integration layer rather than isolated security selection, because we are leaving a lot of alpha on the table. What does the future of global investing involve? If you zoom out, right? We started with security selection from the Graham and Dodd kind of era, CAPM, and the FAMA French 3-factor, 5-factor. We went into security selection, the modern portfolio theory for the Markowitzes, to CAPM, the FAMA French 3-factor, the Carhart 4-factor, 5-factor, adding other factors like the low risk factors. We've gone from there, and now we're coming to country allocation. How do we tackle the problem at the country level so that we can capture that, extract those alpha there at the sector and the country level, and to integrated systems? Because this integrated system of the macro integration layer is a problem even in the factor-based stock level investing as well. They don't integrate that because they don't tools. So we are moving into that layer of how do we integrate macro into factor level investing, and that's the final stage we are, the integrated framework. The future of investing lies in integrated, multi-layered decision systems that unify data, macroeconomics, and portfolio instruction, right? So what are the key takeaways, right? I just had a lot of concept that were covered. So I just want to summarize here, right? Country returns are not random. They exhibit structured and predictable variation. Factors can also extend to countries, and integration is the next step that needs to be tackled. And macro integration is what is missing, both at the stock level and the country level. So global equity investing is evolving towards a systematic multi-layer allocation frameworks that integrate factors, macro intelligence, and portfolio construction. I want to leave a closing thought here before we get into the demo. The investment industry, as even though they want to move towards a country level allocation, the tools are very limited. The tools have not caught up. It's under-instrumented area of investment management. There's a lot of tools for security based, and this is where Borealis is trying to develop tools in this area. The tools we have not fully caught up to the levels and standards of the rigors of security selection, right? So with that, this creates sort of an opportunity for practitioners, right? While capital is trying to move to country level at the aggregate levels, the supporting frameworks, which is yet to evolve completely, creates an opportunity for folks in the finance industry or the investment management industry, systematic integrated approaches. All right. So before I get into the demo here, we have developed an app. I've shared these resources with JD as well. But if you want to explore additional research and analytical tools related to systematic country allocation, we have a free resource, and it's basically free of charge. You can reach out at app.countryselection.com. And anytime if you have any questions, students, academics, practitioners, asset managers. If you have any questions in this realm, please reach out to me and I will share my experiences of how I've tackled some of these challenges. So with your permission, I'm going to just give me about a few seconds. I'm going to switch my sharing screen to my demo. So I've got about 9 minutes. So I'm going to take this into a demo. So this is a platform that I've aggregated. I've read a lot of literature, have parsed through a lot of literature in this level of thing. It's a domain that started in the 1980s through a group of economists that emerged from Salman Smith's money, which got bought out by Citigroup. And I basically took it on from that group in the late 2000s, early 2010s, and basically created a new branch on country level investing kind of a deal. And we have written papers in this realm. So we called out about 120 factors, single factors. You can see on the left, value factors, whatnot, size, seasonality, reversal, price risk, momentum, whatnot, liquidity, investment profitability. We compiled about 120 factors. And I said one of the challenges that I discussed in the presentation was people don't discuss about combining factors. And we also have a platform to combine factors. So roughly we've got about 7,000 odd factors, single and combined factors. We try to express this story in charts and dashboards. We got about 7,400 dashboards, about 500 million charts, about 500 million charts, roughly generating about 600,000 model ideas, right? And factor ideas. And then we have also the macro integration layer that they didn't go into it, but we've developed a macro layer as well. We call that a macro pulse AI, but that's a topic for a different discussion. And so we come up with this list of massive factors, about 3 to 5 terabytes of data that supports this platform. It's through pure research-based platform. So let us take a story here. I'm going to just focus on single factors to begin with. And I'm more focused on developed plus emerging countries. And I'm going to do an analysis based on a look back of 10 years. And we're only interested in value weighted portfolios, right? And let's say I'm searching for an idea that gives you a highest Sharpe ratio. All right. So let's look at this. And this based on a data as of, say, March 31st, 2026. And you look at here, right? The universe is here, developed plus emerging markets, and you see a lot of good Sharpe ratios at this level. This is primarily at the country level. Mind you, there's no security level selection happening here. It's just primarily country selection, right? Look at 0.88, 0.82. This is the kind of alpha that I was trying to talk about that we were missing out by not capturing country premiums. Let's take a small example. Since this is not a marketing pitch, but I'm not going to go into the features of this product at all. It's just primarily on the research. So let's take asset turnover, right? It's an idea. I'm going to click on it and take you to this story here, right? Higher asset turnover countries at the aggregate, indexes that exhibit higher asset turnover would outperform countries with lower asset turnover, right? So let's take a universe that we are all interested in. Let's do develop plus emerging at this point, right? And this is what it looks like. It's about 48 countries, 24 developed and 24 emerging. Look at the countries in the top quintile. The top quintile has got the most attractive on this factor, and the ones at the bottom have got the least attractive, right? Let's look at the ones which are very attractive on the top, and you see the list there: India, Germany, Brazil, and all. Let's see where does New Zealand fit in the story here. It's at ATO rank number 11, so I think it's in the second quintile. So I see New Zealand is in the second quintile. On the bottom quintile, you see countries like Spain, Malaysia, and all that. So this gives you an idea how the allocation has been over time. So this is as of March 2026. We could see what the historical allocation has been over time. I'm just not going to go through the whole journey here, but it's something that you could see how it's evolved over time. You can closely focus on New Zealand here and see how this New Zealand has performed on the spectrum, right? I'm going to stop this at this point. And now we want to say is the next question we want to look at is, hey, let's look at the performance of this idea, right? So we could do this from a lens from purely indexes, or you could look from the ETF. And I want to focus right now on the indices because just because of want of time, I'll not be focusing on ETFs. Let's just focus on how this portfolio is creating using raw indexes. How's it performed? We have also implemented using ETFs as investment vehicles. We could use futures as well. So let's look at index portfolio analysis, right? So let's take the simple analysis. I've got so many, I said 500 million charts, right? So I can't go through all of them, but so let's look at growth of $100, right? Let's deselect all this. Top quintile, bottom quintile, and the market weight benchmark. So you see this with $100 in 1996, it ends up somewhere here with 4,189. The red is the low quintile, and this is the black line is the benchmark. So you see that it's really outperformed the benchmark as well as the low quintile, right? Now this is the full history, right? Since 1996. Does the story change as we change more across decades? We talked about factor persistence, right? Let's try the story a little bit different. Does the story change in the last 10 years, right? We look at the full history over 30 years, right? Let's look at trailing 10 years. Deselect all. Let's look at top quintile, bottom quintile, and bottom quintile. And I think I made an error previously. I should have chosen developed markets. Any market. I should have chosen developed plus emerging. But let's stick to all markets at this point. That includes frontier too. And look at the market. Does the story change? No, the story doesn't change. So it's just been persistent. Let's just switch the universe a little bit and see, does the story change at the developed plus emerging markets? The same story. Top quintile, bottom quintile, market rate. The story doesn't change. $100 invested 10 years ago would yield about $383 now, compared to what is at the bottom here for the red, which is basically bottom quintile would yield you 245, whereas the benchmark would have yielded you 307. So it is pretty much the story distance still remains the same over the trailing 10 years using developed plus emerging markets. Let's take this to the trailing full history, which is about more than 30 years. Does the story remain the same? Yeah, it does. And bottom quintile, it does. It's $100 would have given you 4,273. So this is about persistence, right? The story is about persistence. All right, there's so much analysis you could do. You could do it with equal weighted the countries, or you could do the value weight. I was focused on so far on the value weighting. Now you're more interested in one of the other challenges that we discussed, right? Research focuses on single factors, and we've figured out we can also combine factors. Momentum can be combined with something else. So I'm going to do the same journey. I'm going to exclude single factors and focus on multi-factors, right? I'm turning it on. Same thing, developed as emerging based on the trailing 10 years, highest Sharpe ratio. Look at this, right? You got some, when you combine, look at the Sharpe ratios bump up to 1.05. Let's take book to price ratio combined with sales growth, right? Same journey, same story. And let's do the same thing with growth of $100 a time, right? We're focused on developed plus emerging. We are focused on value weight. Let's the story hold in terms of factor persistence. Deselect top quintile, bottom quintile, market benchmark. Now it's the bottom quintile is outperformed, right? In the trailing 10 years. So top quintile only yields you $281 if it invested $100 10 years ago, whereas the bottom quintile is going to give you about $501. So it's a significant flipping, right? The bottom quintile has really outperformed the top quintile. That's great. So it's telling you a story here. Now, does this story hold if you go back in time even further, right? Full history, right? The same thing, same story, developed plus emerging markets, right? Top quintile, bottom quintile, market benchmark. Does the story hold again? See, the story slightly sort of flips a little bit. That means if you look at it, if you looked at a time period, if you include the time period before 2017, right? 10 years ago, it's about 2016. It is the top quintile which outperformed, right? It's consistently. And there was a brief interlude during the COVID years where the bottom quintile outperformed. So this is what I'm talking about, is the regime switching. What time does it switch over? And when we apply this LLM-based principles on top of this, this gives you a better story, which I'm not covering macroeconomic layer onto this, but this gives you a story. I want to take this because of one time. I want to quickly rush to one more part, but that will be very interesting for you guys to look at. And it's called, how do we look at New Zealand? New Zealand, let's pick up the country New Zealand, right? We got about 80 countries we look at. Let's look at New Zealand from a perspective of factor-based, right? Let's look at this, and let's look at it from a three-factor model, right? From a French three-factor model. How does it look at, right? Now you saw the value, size, and the market risk premium, right? All after market risk premium is after adjusting for size premium and the value premium, right? Look at the T-stat on this. It's 11.59. So market risk premium is influenced by global factors. That means is size. Definitely look at the T-stat, 3.14. New Zealand stock market is a very small market, and it's definitely the size premium plays with New Zealand, right? Does value play much? No. So it's basically a small country effect, and the global markets does influence this the premiums for New Zealand. How does your neighbor perform on the same spectrum? Let's do a with Australia. Just create the same story here. Market risk premium, definitely. Not so much of a thing, but still it does have a small premium compared to you looking at with respect to US, which is about 67% of the global market cap. Let's look at the value story. This value story adds up. T-stat, nah, not great, right? So this gives you a good idea of how we apply these frameworks at the country level. I want to take the story a little bit to get to the 5-factor, right? Let's do the FEMA French 5-factor and see does this hold up there too, right? So this is Australia. Let's go back to New Zealand. I'm looking for it. Let's play this. Let's deselect all. We added size to value and size. We've added profit and market. We added profitability and investment, right? Let's select. So let's pick. As it's because barely T-stat of my 2.03, right? Let's add market definitely, right? We already discussed that in a 3-factor model. What about profitability? Does it explain the story? Barely, but on the negative side, right? What about size? Size still, in spite of all these factor premiums, size is playing out. So what does it tell you? New Zealand has got a small country effect. This is a very interesting property of New Zealand, right? And value, right? Not much. So basically, the properties exhibited by New Zealand index is not a value kind of index. So I was talking to JD just before this conversation started. If you had those of you who watched New Zealand in 2014, 2013, 14, what was the effect that you saw with New Zealand? It was a low risk phenomenon that you saw with New Zealand. It had a tremendous run in 2014, and that was a low risk anomaly. That's the first time that was seen in action, manifested through New Zealand. So with that, I think it's time for Q&A, because if we barely have time to basically take some questions. So I can also have one more. Can we just do one more Carhart 4-factor model before we take the Q&A? I believe we just still have time, maybe a couple of minutes more. So, and as I said in my conversation, right, Fama French, they typically excluded momentum from this entire discussion. And I believe the efficient market hypothesis, the Chicago school, they firmly believe in the fact that momentum is a recalibration. It's not an anomaly. This is where I think Carhart came into picture, and using the mutual fund study, is using the U.S. mutual fund industry data, figured that is, he believed that momentum is an anomaly and is a persistent anomaly. And I think it's a different frameworks and different thought, the conflict that exists in this industry regarding momentum. But if you were to include Carhart's 4-factor model, how does New Zealand explain that story? I'm going to go back to New Zealand. We are still in New Zealand, right? Yeah, it is. Momentum is in green, right? It doesn't. The momentum premium doesn't explain many things that's happened with New Zealand in general. So it's basically size effect, and it's the value thing as well. So with that, I'm going to stop sharing, and I'm ready to take some questions at this point, JD.
Great, thank you for that, Sailesh. Look, very, very interesting, and love to see your passion about this topic as well. It's really great to see how you present on this. And I think what's really good also to have a look on how this plays out in the New Zealand market, and as you said, also in our neighbors as well, and compare the two. So I'd like to open this up for questions to Sailesh. I'm going to give it maybe a couple of minutes or so for if there are any questions to come through on the chat. So if you just want to use the chat and maybe type your question in there, that'll be great. While we wait for it, just a reminder that I will share Sailesh's paper and presentation. And then I believe Sailesh will also have a link to your platform for some of the people to go and have a look if they'd like to have a play in the platform as well.
Any professors, academic community, students from University of Auckland or any other universities in New Zealand, please reach out to me. I'm ready to do workshops on how to apply factor-based principles for country-level investing. Please reach out, and I'm happy to do this free of charge to anyone interested in going through this workshop.
Great. Looks like my chat is disabled actually, so I wonder, Helen and Teresa, if there's maybe something else that we can do, if there's maybe any questions that's coming up where we can have a look.
Looking forward to any critiques because I'm not perfect. I do not have all the answers to the thing. I would love to learn from you folks through your questions because I'd love to see your feedbacks as well.
I think maybe one question from my side at this stage, Sailesh. So at the start of this webinar, I referred to, me personally also having a keen interest in this topic. And I mentioned to you also the other day that this is quite a bit of work from my side that I did on the South African market specifically, but also on an equity level rather than, on a country level. So very interesting to see, how this applies as well and how it can be applied on a country level as well. So in your experience, and I don't know if this is something that you might have done already, but if have you started constructing portfolios either for yourself, customers, institutional investors, that's purely based on country allocation, or is it a combination maybe of both?
All right. So JD, the inspiration to build research frameworks for country level investing started off from my background. Which I didn't mention in my introductory introduction. I was the first in the United States to build institutional level portfolios using single country ETFs. I was the first to basically use research. And as I said in earlier part of the discussion, where this is a topic that came off in the 80s and then this thing died. And then in the late 2000s, I brush it up and bring it back. And I had the fortune of basically building a portfolio of for Blue Cross Blue Shield here in the United States, so first in the country to build institutional level portfolio for $150 million. And we use ETF, single country ETFs. And I collaborated with iShares to build this portfolios. And I remember in 2014 or 16 when I was trying to build this, and I did use New Zealand ETF as well at that particular point in time. So there is there's a group as well in the United States out of the West Coast who have done this for retail investors as well. And the interesting thing is that people don't realize is that ETFs is not the only tools to use to deploy country level allocation. If you want to build portfolios, you can use also country level index futures to deploy this as well, right? And that's been done by a few other firms in the West Coast as well. So I personally have done this for Blue Cross Blue Shield of South Carolina, and that's how when I figured out the challenges of building platforms around countries, and none of the tools existed, and there's a severe shortage of tools, and that's when I was inspired to build these tools around country level investing. So basically, there's a professor by name, those are for your academics. There's a professor by name Adam Zaremba who does this, who brushed off the initial research, the brushed off the dust of the original research done in the 80s, and he started up this new framework in the 2010s, 13s kind of a deal. His name is Adam Zaremba. He's a professor at Montpellier, and he sits as an advisor on my company as well. And I've also, and those of you who have not read my paper on Journal of Portfolio Management, I've taken Schiller's P to pick countries as well. I modified Schiller's P, which is basically from the irrational exuberance that came out from the tech market bubble of the late 2000s. I applied it to countries outside of United States, and I applied it to about 54 to 60 countries. And we call this as modified Schiller SP. All I did is I modified the value principles of price to earnings ratio. I modified it to law. I brought in the concept of which Thaler built with his Nobel Prize winning research, which is the behavioral investing, which is long-term reversal. I added long-term reversal, and what I did is I did a sweet technique there. I modified Schiller's P to also include a cyclically adjusted real exchange rate, because the why real exchange rate is basically captures earnings should be always be adjusted for nominal terms. We did real exchange rate RER, and I captured this to create a new metric called the modified CAPE. So I've deployed that as well to build portfolios using just modified CAPE as well. And Meb Faber has also done this through an ETF that you can see. He's also from the West Coast. He's a friend of mine as well, but he has done it using just purely on CAPE. He's done it both at the stock level as well as at the country level as well.
Right. Thanks for that, Sailesh. It seems like the chat has now been enabled, so that's great. So just going to give a few more seconds if there's maybe any questions coming through. So while we wait maybe for one or two more questions. So the other question from my side, Sailesh, is that, obviously from a research point of view, all of these things tend to be quite dynamic, and over years, all of those research that you've mentioned as well, the factor models and so on, where it gets published for the first time, it gets validated, or it's been regarded as something that's not necessarily an anomaly as such, but maybe integrated in something else. Do you foresee that, a number of these factors that you've mentioned today as well, and the approach of, building your country based factor portfolios will continue to change and true to the nature, I guess, of capital markets being very dynamic? And how do you see that change going forward?
Yeah, perfect. That's a very good question. I think I was alluding to it in the presentation as well. So, JD, from a perspective of historically how this is going to revolutionize this area of macro investing is that so far every country selection idea that happens at an institutional level, right? Asset allocation in terms of equity asset allocation at the country level happens primarily on a discretionary basis, judgmental way using macroeconomics, right? And we have seen historically that macroeconomic indicators are very poor predictors of country returns. Be it inflation, people look at GDP, a lot of it, but many of stock returns are pretty much leading indicators of some of those metrics. So you can't use them in country allocation, and I've done research on that as well. And that's why this factor-based principle adds a new dimension to this field. But it is not that is alone is not the game changer. The arrival of LLMs have changed this industry, and not many people have applied it at that level. And as I was telling you, this is a topic for a different discussion. But how can we apply LLMs? And that's a part of the paper that I shared with you, the white paper, right? How can you apply LLMs? Integration of the macro to factor principle is the game changer, right? And everybody is trying to, and JD, the industry is evolving to, nobody wants to pay management fees, right? Everybody's trying to get it indexed, right? Everybody's doing a race to the bottom, getting the low management fees. It's basically, in terms of prices, they're going racing to the bottom. And so nobody wants to, so basically everybody's trying to automate the industry, the asset management industry. And this is where these kind of principles can be automated, systematized, and this is the way it's going. And I'm not sure whether you are aware of this. There is this platform called the Turkey Asset Management Programs, TAMS, where they're trying to automate the entire investment advisory industry. Right now, the trading has been automated, CRMs have been automated, compliance has been automated, but nobody has made a serious attempt to automate research and allocation decisions, security selection decision. That's the next wave. And a lot of companies are coming in this narrow sleeve of automating research. It's happening in security selection, and this LLM has given a new spring to the feet of country level investing that's not been done before. That's why that discussion on LLMs, applying LLMs for macro integration to factor investing is the game changer. That is the game changer both at the stock level and the country level layer. So for me, I'm into a brand new territory. Nobody has done this. Nobody's instrumentalized this area. So I've got two dimensions, the LLM dimension and the factor dimension. Those people are practicing at the stock levels. The LLM is the new dimension that adds to that factor-based investing in stocks. So this is where the game changer is. LLMs is definitely a game changer.
Yeah. That's great. And I think that's a great segue also in terms of, where we want to go with this discussion next. So it would actually be fantastic, to have another one maybe later this year as well to hear you talk on the LLM part as well.
Perfect.
So no further questions has come through online. Mindful of time, so I'm just going to conclude there. And again, thanks, Sailesh, for sharing your research with us. Clearly, as I said before, very passionate about your field, and it's great to see. It's great to see how this field is evolving. And as you say, a number of things that's going to be a game changer. And it's great to see, and have someone that's on the forefront of that to talk to us here in New Zealand. So thanks again for that. And to all the attendees, as I've mentioned before, I'll send the papers that was shared to us by Sailesh, and as he also invited academics, students who are interested to have a play on the platform, please reach out to him, and I'm sure you'll enjoy that as well. So that concludes today's session, and thanks very much.
Perfect. Thank you guys. And thank you, CFA Society New Zealand, for inviting me. And thank you guys, and have a great rest of the day, and see you later. All right, guys. Bye bye.
Thanks, Alish. Bye bye.